Welcome back. Today, we are going to follow the money. We're diving deep into the world of payment cards, and we're using the expert material for PCIP candidates to light the way. Our goal? To pull back the curtain on that incredibly complex, super high-speed network that literally springs to life every single time you buy something. It's a world filled with specialized banks, massive global networks, and split-second decisions that are, let's face it, the bedrock of modern commerce. So let's get started and trace the journey of one single transaction.
I mean, think about it. The last time you bought a coffee, you tapped your card, you heard a beep, and you walked away. It feels like magic, right? Instant. But behind that simple 2-second tap is a lightning-fast conversation happening across the globe. We're talking half a dozen different organizations all playing their part perfectly. It's this incredible symphony of tech, finance, and security. So what is actually going on in the moment it takes for that approved message to pop up? Well, that's the mystery we're solving today.
So here's how we're going to break it down. We're going to follow a transaction from the very beginning to the very end. First, we'll peel back the layers on this everyday mystery. Then we'll stop right at the point of sale to meet our first couple of key players, the merchant and their bank. From there, we're going to hit the road on the global payment highway run by those big card brands. Then we'll land at the bank that actually gave you the card for its moment of truth. And this is a big one. We will finally untangle the difference between getting an approved message and when the money actually moves. And then we'll put it all together to see the full picture and understand why every single one of these connections is so critical for security.
So let's start with the puzzle itself. That simple tap or click you make kicks off a process that seems like magic, I know. But by the end of this, you're going to understand every single move. And you know, it's so much more than just money zipping from point A to point B. It's about data, it's about risk, and it's about trust being exchanged across a massive global ecosystem. Understanding this flow? Well, it isn't just for fun. For a payment professional, it is the absolute foundation of designing effective security.
Okay, so the first thing you really got to wrap your head around is this. A payment is not a direct transfer. It's a multi-party conversation. It's governed by a super strict set of rules, and it bounces between all these specialized financial institutions that each have a very specific job. A request for your money is born at the checkout, it travels across the country, maybe even the world, gets checked against fraud models and your bank balance, and an answer comes all the way back, all in about the time it takes you to blink. The beauty of the system is that you, the consumer, never see any of this. The complexity, well, that's the challenge for us security pros. So, who are these institutions having this crazy fast conversation? Let's meet the first two.
So this whole high-speed conversation, where does it kick off? Right at the point of sale. And this is where we meet the first two critical players in our story, the merchant and their partner, the acquiring bank. You have to think of this as the front line of the entire payment ecosystem. It's where your cardholder data first enters the system. And because of that, it's one of the most critical environments we have to secure. Literally everything that follows depends on the integrity of what happens right here.
All right, first up is the merchant. Now, I know this sounds super obvious, right? But it's the official term for any business that takes your card. And according to the expert material, that could be a classic brick-and-mortar store, a huge online retailer, a food truck with a little card reader, or even a subscription service you use. They are the ones who start the entire payment process by grabbing your card details, and in the eyes of the PCI Security Standards Council, they are one of the primary parties responsible for keeping that data safe.
Now, what's really fascinating here is how we frame the merchant's role. They're not just selling you stuff. They are, for all intents and purposes, the face of the payment industry to the public. By deciding to accept cards, they're agreeing to play by the rules of the big brands. They're the ones who install the hardware, the card readers, the POS systems, or the software, like those online payment gateways that act as the front door for your sensitive data. And this last point is huge. As the expert material states, the expansion of card acceptance by merchants is the #1 engine of growth for the entire industry. Every new coffee shop that starts taking cards expands the ecosystem for all of us.
Now, a merchant can't just plug a card reader into the wall and hope for the best. They need a special banking partner. This is the acquiring bank, or what we just call the acquirer. Think of the acquirer as the merchant's financial wingman for all things cards. Their main job is to set the merchant up with what's called a merchant account, which is just a special account that lets them take card payments. They handle the tech connection to the card networks, and most importantly, they're the ones who eventually collect all the money from the approved sales and deposit it into the merchant's business bank account.
And to make this real, the expert material lists banks you definitely recognize, like HSBC or Bank of America, who act as acquirers. Any business that wants to take cards has to partner up with an institution like one of these. And that partnership is really important because the acquirer is basically vouching for the merchant. They check out the merchant's risk of fraud or going out of business. Because if a merchant can't cover refunds or chargebacks, well, guess who's next in line to pay? The acquirer. So, the merchant has your card data, they've passed it to their acquirer, but where to next?
This brings us to the super connectors of the payment world. Okay, so the acquirer has the data, but how does it get where it needs to go? It's not like they have a direct phone line to every single bank on the planet. They need a central network, a standardized highway system to carry that data securely. And that is the essential role played by the payment brands. They are the architects, the builders, and the operators of this global highway.
So what are these payment brands really? Well, think of them as the air traffic controllers for money. They are the absolute core of the network. Their entire reason for existing is to connect the thousands of acquiring banks with the tens of thousands of issuing banks around the world. And it is so important to understand what the expert material points out here. They don't issue cards to you, and they don't hold your money. Their business is the secure, reliable, and standardized movement of transaction data. They build the rails, and all the banks run their trains on them.
And yep, these are the logos you see on your cards every day. Visa, MasterCard, American Express, and the others. But they aren't banks. They're the architects of these massive networks that connect pretty much all major financial institutions on Earth. This is what lets a card from a tiny bank in Nebraska work perfectly at a metro station in Seoul. Now, Visa and MasterCard run what's known as a four-party model. That's them, the acquirer, the issuer, and the merchant. American Express and Discover historically used a three-party model, where they were the brand, the acquirer, and the issuer all in one, though that's changed a bit over time.
Okay, and this is a really, really important point, especially for you folks in security and compliance. The payment brands don't just provide the network, they govern it. You can think of them as the government for the payment world. They set all the rules of the road, including all the technical specs for how data has to be formatted and sent. And most importantly, they create and enforce the security standards. You guessed it. The PCI DSS comes from the collective power of these brands. They also decide what it costs to use their network, which brings us to two very different types of fees.
All right, this table lays it all out, and getting this difference is a game changer. Let's look at the left side first, interchange rates. The easiest way to think about this is a fee the merchant's bank pays to your bank every single time you use your card. The payment brand sets the rate, but the money isn't for them. It's meant to pay your bank back for the cost and risk of the whole deal, the risk of fraud, the cost of your travel rewards, and so on. Now look at the right side. Assessment fees. This is different. This is the fee that both the merchant's bank and your bank pay directly to the payment brand, like Visa, just for the privilege of using their secure network, their brand, and their anti-fraud tools.
Okay, so our little transaction request is traveled from the merchant to their acquirer and across the huge network of a payment brand. It is now arriving at its final destination for a decision. This is it. This is the moment of truth for the transaction, and it all happens at the one bank that has a direct relationship with you, the person trying to buy something, the issuing bank.
So the issuing bank, or the issuer, that's your bank. Simple as that. It's the institution whose name is probably right there on your card, next to the Visa or MasterCard logo. They're the ones who gave you a credit line or let you open your current account. They issued you the plastic. And because it's their money on the line, or your money they're protecting, they have the final say. They have the ultimate authority to give the yes or the no on the purchase.
And the craziest part? This whole decision process happens faster than you can blink. Their systems get that authorization request from the payment brand, and in a fraction of a second, they run this incredibly complex series of checks. They verify the card number, the expiration date, the security code. They check the account status. Is it active, frozen, reported stolen? They run the sale through super smart, real-time fraud models. And then, the final check. Do you have enough money or available credit? Only when every single one of those checks comes back green is an approval code generated and fired all the way back down the line.
Okay, so you get that approved beep at the terminal, you grab your stuff, and you think it's all done, right? Well, for you it is, but for the actual money, its journey is just getting started. This brings us to a really critical distinction that every single payment pro has to master: the difference between authorization and settlement. They are two separate and equally important journeys that every transaction takes.
Okay, listen up, because this is probably the most important distinction we're going to talk about today. Authorization, the whole process we've been tracing so far, happens in real time. But it's just a data message. That's it. It's basically a promise from your bank to the merchant's bank saying, yep, the funds are here, we approve this, and we promise we'll pay you. But no money has actually moved. The actual movement of money happens later during settlement.
This is a totally separate back-end process, usually done in a big batch at the end of the day. The merchant system sends all its approved sales to the acquirer, who then gets the funds from the issuer. To put it simply, authorization is the promise, settlement is the payment.
Okay, we've met all the players. We get the high-speed trip of the authorization request, and we've seen the separate, slower journey of the actual cash during settlement. So for our last section, let's zoom out and put all the pieces of the puzzle together. We're going to trace the key connections one last time, from the moment you tap your card to the moment the merchant actually gets paid. So let's follow that data one more time. You tap. The merchant system captures the data and sends it to their acquiring bank. The acquirer sees it's a MasterCard and shoots the request onto the MasterCard highway. MasterCard's network instantly finds your specific issuing bank and delivers the request. Your bank runs its checks and sends the approved message all the way back along that exact same path, lighting up the terminal. That's authorization. And only later, probably overnight, does the actual money move from your bank through the network to the merchant's bank. And that's settlement.
So, after all that, what's the big takeaway? Why do you, as a professional, getting your PCI CP, need to know every single stop on this journey? Because understanding these connections is the absolute bedrock of payment card security and compliance. Every handoff, from merchant to acquirer, from acquirer to brand, from brand to issuer, is a point where data needs to be protected. Each of these players has specific responsibilities under the PCI DSS. You simply cannot secure a system you don't understand, and protecting cardholder data means protecting it at every single point in this complex, interconnected web. And that leads me to my final thought for you today. Now that you can see this whole map, from the little terminal of the coffee shop, across global networks, to a bank's massive computer system, and all the way back again, I want you to think, where's the weak link? Where do you think the biggest security risks really are? Is it in the old point-of-sale terminal at a small shop? Is it the API connecting an e-commerce site to its payment gateway? Or is it how that data is stored at the end of the day before settlement? Thinking critically about this question, well, that's the first step to building a truly secure payment environment.